Hey folks, David Berkowitz here. Today we're diving into a topic that excited value investors, a stock price drop after an earnings report. We'll examine General Motors and why a recent dip might be a buy signal. Please take a second to subscribe, hit the bell, and click the like button. Now, I know what you're thinking. GM, really? They just reported earnings, and the stock dropped about 9%. Yes, that's precisely what happened, and most people are running for the hills. But here's why a drop like this creates an opportunity. First, let's talk about the earnings game. Companies often get trapped in a cycle where they're obsessed with meeting or beating quarterly earnings expectations. They'll cut costs on critical long-term value drivers like R&D or marketing just to meet their numbers. The problem is, the market fixates on short-term results instead of long-term value creation. GM took a hit to their EPS this quarter because they decided to shelve the development of their Cruise robotaxi and restructure their Chinese operations. This was a $4.5 billion hit. That's significant, and most investors are likely running away because of this. But what if those decisions are great long-term moves? As I mentioned on the Create More Value podcast this week, there are three ways to get an edge in the stock market. Number one, information. Number two, analytical. And number three, behavioral. Most people think the informational advantage is key, but here in 2025, the behavioral advantage is crucial: how people act and react to news and events. Most investors are selling about the earnings outlook for GM. They focus on the headline and immediate reaction, not the underlying value. Here's where we, as value investors, can exploit that. You see, most of the market is focused on the short term. I look for companies managed for long-term value, not short-term share price, and that's where the analytical advantage comes in. The first analytical advantage is valuation. GM stock has consistently traded at low multiples. Bill Nygren of Oakmark has called it ridiculously cheap. You must look closer when you notice undervaluation combined with negative short-term news driving down the stock market price. That's just the short term. However, as value investors, we know these short-term drops can create buying opportunities. The advantage is understanding management strategy through the value-based framework. GM CEO Mary Barra is focused on long-term value creation. She's willing to make hard decisions to reduce costs and improve efficiency, even if it means short-term hits to earnings. Next up is flexibility. Part of the recent drop was due to management's guidance not accounting for potential tariffs, which are unknowable. Barra has emphasized that GM has multiple flexible production lines and can move production as needed, making GM less susceptible to trade-related risks than its competitors in the long term. Another key thing I look for is companies that don't play the short-term earnings game. Do they give quarterly guidance? Do they focus on EPS? Do they cut spending on value-adding projects to meet numbers? Companies like that will defer investments that made sense when approved. They created intrinsic value then, but deferring or canceling those decisions to make the numbers destroys value. Value-aligned companies don't play the earnings game, and GM, as we will see, appears not to participate. In another video, I describe how we identify value-aligned companies. We first screen for the top 10% economic value added, or EVA, performers in the Russell 3000 index. We do not usually invest in banks because most do not fit our criteria for a value-aligned stock. For instance, banks are generally not in the top 10% in EVA performance, and big banks do not have an ownership culture. There are exceptions, of course. Insiders at small and mid-sized banks often have meaningful skin in the game. Within the universe of value-aligned companies, there are three buckets of top EVA performers. The first category, aligned owners, refers to companies where the management and employees, regardless of their specific roles, tend to think and act like owners, demonstrating a long-term commitment to the company's success and a deep alignment of interests with its shareholders. The second, Titans, comprises companies operating in industries where only a few players dominate the market. These companies are attractive to investors because they often have high returns on capital. The third, Pac-Men, are stocks that consistently and heavily buy back their shares to increase the value of the remaining shares. These share buybacks are beneficial when the shares are trading at stock market prices below intrinsic value. Now, let's look at some specifics from GM's recent performance. In 2024, GM's full-year revenue increased by 9% to $187 billion. Full-year profits were up 38% to $10.60 per share. The company achieved record operating income, automotive free cash flow, and EPS. GM was number one in the U.S. in retail fleet and total sales, growing market share and reducing pricing incentives and inventory pressures. Its U.S. market share for the entire year was up 30 basis points to 16.5%, ending at 17.5% in the fourth quarter. Regarding value-aligned moves, GM has a robust share buyback program, indicating that management believes their stock is undervalued. GM is a Pac-Man stock. I love to see that it has been aggressively buying back its shares. General Motors' share buyback program drives shareholder value, boosting earnings per share even without significant net income growth. GM $14 billion in adjusted auto-free cash flow and returned nearly 55% of this to shareholders. It reduced its share count to 995 million from 1.5 billion in 2021 by the end of 2024, a goal the company reached ahead of schedule. Shares outstanding decreased 12.6% per year and 33.3% in just 3 years. Looking ahead to 2025, GM's guidance focuses on long-term value creation. They're projecting EBIT of $13.7 to $15.7 billion and EPS of $11 to $12 per share. They also anticipate an adjusted automotive free cash flow of $11 billion to $13 billion. Now, I'm not giving you specific investment advice you should always research, but I encourage you to look at GM and other stocks from a long-term perspective. Don't get caught up in the short-term news and emotions. That's where the real value lies and the opportunity to buy shares of great companies at huge margins of safety. The market's focus on the short term creates opportunities for long-term investors. Don't fall for the hype and the headlines. Understand a company's intrinsic value per share. Do your research. And when the market overreacts, be ready to buy. That's when the real gains are made. Thanks for listening. Don't forget to subscribe and hit that like button.